Hey guys, it's that dividend guy coming at you with another dividend investing video. So, one of the concepts that I've introduced on the channel, especially with how shaky the market has been, are stocks that have actually cut their dividends. And I've done a list on this before. I found a couple other lists, but they were kind of repetitive. These were ones that were not included in the original video. So these are 5 more stocks that are big blue chip companies that have actually ended up cutting or suspending their dividends entirely. So let's take a look to see what they have to say. The blue chip stocks slashing their dividends. The largest of the blue chip stocks to entirely suspend its dividend has been aerospace and defense giant Boeing. Yes, the company's 737 fiasco had been an ongoing nightmare even before the pandemic, but the virus' sudden decimation of air travel came as a double whammy, threatening Boeing's production pipeline and cratering demand for future planes. In March, the company announced it would be suspending its dividend until further notice, pausing share buybacks, and the CEO would forego pay in 2020. The company also began angling for $60 billion in government aid. The day before this announcement, Ford announced its own dividend suspension. The legendary American auto manufacturer paid about 2.4 billion in dividends in 2019 and was yielding more than 13% at the time due to a steep sell-off. The company also drew down on more than 15 billion in lines of credit, the entire amount it had remaining. Rival General Motors followed suit in April. Shares were yielding nearly 7% when the company suspended its dividend and share buyback program, while also utilizing billions from revolving credit facilities. Storied brands and blue chip perception aside, cyclical parts of the economy, such as the auto industry, were some of the worst hit by the pandemic. This makes sense too that Las Vegas Sands was forced to suspend its dividend entirely in April as well. There's no such thing as social distancing at a craps table or roulette wheel, and Las Vegas Sands wouldn't have been doing its duty if the casino operator hadn't stopped burning cash with dividend payments. Its lucrative Macchio casinos saw revenue decimated in the first quarter, making quick work of a yield that had reached almost 7%. Another 20 billion plus company, oil field services from Schlumberger, cut its dividend by 75% in April. It was yielding about 13% at the time. Combining the move with the broader restructure of the company, the firm laid off 1,500 workers in North America last quarter as the energy prices plummeted among a supply glut and falling demand. Although there are dozens of examples of prominent companies cutting their dividends recently, the key for investors is to gain some understanding of how to best avoid these situations. So then they go into how to know if a dividend is not safe. So how can you tell whether or not a dividend is safe? Generally speaking, there's a simple checklist of sorts that investors can follow to avoid stocks that are cutting dividends. And here are some key points to consider. So just to go back over the list, it was automakers, oil, casinos, and the aerospace industry. So not surprised. But here are some things that you can look out for to save yourself from this, and this is really the point of this video and the last one as well. I am a dividend investor. I love dividends. I love dividend growth. That's how I plan to retire, is buy quality companies at a great price that have increased their dividends over the course of 25 to 50 years. That's my entire investment strategy. That's my philosophy. I think you should hold quality, and if it's true quality, it will pay you more every single year. Simple and easy. But the thing is, there are certain things about dividend investing that can really bite you if you don't do your due diligence when you initially buy a company. So let's take a look and see what some of the common misconceptions about dividend investing are, and see what a lot of people that dividend invest actually make these mistakes. So let's take a quick look real quick. So be suspicious of high yields. The most important thing is not to chase the yield. Often that too good to be true dividend yields is just that, a yield, a high yield because of a large price decline due to bad news. Make sure you are evaluating the quality of the company alongside the dividend yield. And this is really the key. So, what I mean is, let's think of something like if you see a double digit yield on a stock, it's probably too good to be true. Even if it's a REIT. And those, most of the time, if you see double digits, it's not sustainable. And the reason a lot of people are getting slammed from this corona thing is because they bought companies that were struggling to pay their dividends before this happened. And the reason that sucks is because a lot of people picked certain companies like, say, Gap or Macy's or Wells Fargo. You know, a lot of the retail stocks, the bank stocks, the aerospace stocks, anything in the airline industry or the automobile industry, a lot of people bought those specific companies because of the yield. Or some, I've seen REITs and some oil and mining companies as well, slash their dividend. Make sure that the dividend is not too good to be true, and make sure, even more importantly, that the company that you've picked makes enough in revenue that the payout ratio isn't. I go for less than 60%. Some of my stocks have more than that simply because they've increased the dividend for so long, but they have enough cash flow to cover it. So if you're looking at a company or researching a company or even own a company that struggles to pay the dividend in a bull market that we had for the past like 10 years, how do you think it's going to fare when the market goes to crap? An economic shutdown happens. Like, I just had a tornado pretty much hit my state. If it can't pay it in good times, it's not going to be able to pay it in bad times. And I see so many investors chase high yield because they think, oh, say something like J&J pays like, say, 2.5%. Well, this REIT over here pays 10%. So this REIT's going to make me more money than J&J is going to. Well, that REIT might pay you, let's say, $1, and J&J pays like 95 cents, let's say. But the thing is, that REIT might not be able to sustain that dividend for longer than 5 years. So unless you put enough money in to buy something, to use that stock to buy something else with the dividend, and you plan on getting out of that stock, there's literally no reason to hold that, because you're not going to get the long-term play that you would in a quality dividend pick like J&J. Just so you know, I'm not a financial advisor. I'm not saying to buy J&J. I'm just saying there's a difference between seeing a high yield and thinking that's going to get me cash over the next 5 to 10 years. It really won't if it doesn't have the cash if it doesn't make enough money to sustain that level of payout for 5 to 10 years. There's literally, or into retirement like I'm trying to do, there's literally no reason to buy the stock then. So keep in mind that if the payout ratio is above like 60% and it's not like something that's like a dividend king or an aristocrat status, you don't want to hold the stock. And I didn't mean to go on a huge rant, but I see this on YouTube all the time in portfolio reviews. People buy stuff like I said, like the automobile industry, like the cruise lines right now, like a lot, like commodity companies that are gonna get slammed by something like the coronavirus or REITs or something like that, or MLPs. They buy these really high dividend yields, and then they get slammed because they couldn't sustain it in a good economy. So when something came that didn't make everything rainbows, unicorns, and happy-go-lucky, they get slammed. Note high payout ratio. I went over this too. So this goes with the high yield. What, like I said, what's the point in buying a mining company that can pay you 13%, but it can't sustain that for longer than, say, a year and a half, versus something like a J&J or a Colgate or a 3M or a Coca-Cola that's been doing it for 50 years. When you look at a company, you shouldn't look at it like, okay, this can make me 10% year over year, versus say Coca-Cola making you 3.5. Of course, you're going to go for the 10% yield because that looks like you're making 10%. Like, oh, I'm going to match the S&P 500. The difference is that company, if you look at the payout ratio and it's higher than like 60% and it's only been paying a dividend for like 4 years, realistically, they can't keep that up, unless there's something drastic that happens. So just do your due diligence. And it says 70% or more is exactly. I wasn't even reading it. That's kind of my safety spot. If it isn't a status stock, which is an aristocrat that has paid 25 years or more, or a king that's paid 50 years or more, and paid the dividend and increased it every single year, because that's what you do with dividend investing. You buy, you buy J&J and it's 90 cents this year. Well, next year it's 95. Then the next year it's $1. So every year, as long as they keep up with inflation, you're going to at least be matching or gaining money instead of losing it. So what's the point of buying a stock if it's only going to be able to pay you a decent amount for 2 years, and then the money you have in that stock is garbage because they cut their dividends. So their whole reason for buying that stock is no longer there. You have to take your money out. You might lose money. You might have to pay taxes on it as well. Plus, the whole reason for it is to hold it forever. So if you're buying a company like that, you're not going to be making money. Check fundamentals, cash flow, debt, earnings, and outlook. Picking safe dividend stocks to buy at the end of the day really comes back to choosing companies with strong fundamentals. And this is really what it's about. if Here's my rule of thumb, and this is how I really do go about it, and this helped me a lot when I started out. If you're wondering what a quality company is, look in your home. Literally, during this video, after this video, like right now, go look in your bathroom. Go look at the toothpaste that you buy, look at the soaps that you buy, look at the deodorant that you buy, look at the brand of the toothpaste or toothbrush, your toiletries, the toilet paper you use, the paper towels. Go look in your fridge. Look at the pops that you buy. Look at the foods that you buy. Who do you pay every month for electricity and water? Who fuels the gas pumps that you go to? See what I mean? Like, if you're paying for it, odds are millions of other people are too. So, like, if I go to the store and buy Coca-Cola, I'm pretty sure somebody else is going to buy Coca-Cola, right? So, like, as long as you buy stuff that you understand, and if you're purchasing it anyway, you might as well buy the stock, because it's like you're paying yourself essentially. Why would you own, like, think about it. I could go out and buy Coca-Cola, right? Or I could go, let's say I buy a bottle of Coca-Cola at a um, vending machine. The person that owns that vending machine makes money, but I make money when they stock the machine. So it's just a different way of making money, right? So why would you not want to own the machine that is Coca-Cola versus just funding it for your entire life? That's how I think of it. So in terms of evaluating companies that may be in line for a dividend cut, we'd suggest looking at cash flows, debt utilization of payout ratios. So what this means is, if a company doesn't have enough cash flow to sustain the dividend, they're going to cut it. If Think about it, if you can't, like, if you have a loan and you can't pay it, then interest accrues, right? It's kind of the same thing for this. If they don't have enough money to pay for it, then they can't pay it. It makes sense. And if they don't, the heart of a dividend is the cash flow, the amount of money that the company makes after its expenses. And also, you want to look at how it uses its debt, because if it's in heavy debt and it can't pay it, or that debt comes to fruition and they can't pay it, they're going to have to get money from somewhere, and a lot of times that comes from the dividend. And the outlook is always important as well, especially during a pandemic environment. So avoid companies whose financial health will be compromised during something like a coronavirus. And what I mean is, people are not traveling. People aren't going to be buying cars. Um, People aren't going to go to casinos. Anywhere that's a closed and enclosed environment with a lot of people in it is not going to be happening. So one thing that we all, as investors, not even just dividend investors, but also growth stocks, need to think about is, what's the worst thing that could happen, and what would happen to this company if something like this did happen. So it's important to get some exposure to, like, airlines and stuff like that. But keep in mind that certain things get sold regardless of if we go out or not, and that's how I invest. That's why I said I looked in my house before I started investing, so I kind of understood where I put my money anyway. If you're comfortable enough to buy Colgate toothpaste, you should be comfortable enough to own the company. If you buy, Kraft Kraft Heinz ketchup, or Kellogg's cereal, or General Mills products, or PepsiCo products every time you go to the store, if you're comfortable enough buying that product, you should be comfortable enough to own the company. And that's kind of how I look at it. Is you should own what you love, and you love what you buy. So you should own what you love to buy. That's my thought process. Um, and then the last thing that they're talking about This is actually really important too. Sorry. Um, so avoid a company whose financial health is deteriorating, yet it is continuing to maintain its dividend. So a company that is losing cash eventually will have to cut the dividend as well. Evaluating the profitability and cash flows of the company can give you insight that past dividend history, uh, like, so what they're saying, they worded it weird, does not, which that's weird. So what they're saying is you have to evaluate how much money the company is making and how much they will make in order to determine whether or not the dividend can still be paid at the current rate. So a dividend, and here's the thing, dividend history really does not matter. I go for aristocrats and kings, but the thing is, I make sure that they have enough money, that every company I pick or I do research on has enough cash to continuously increase that dividend. Because, like I said, I'm holding these for the long term, right? As should you. And one way to protect yourself is to buy the quality companies that have continuous growing revenue to make sure that you're not going to lose your dividend. A track record is a mixed indicator. So many investors look for stocks with long track records for both paying and growing the dividend, which I do as well. It makes sense that dividend growers would tend to outperform the stock market over long periods of time. As a result, many income investors look to blue chip dividend stocks with steady payouts when constructing their portfolios. Dividend growers generally like a modest 35 to 50% payout ratio and growing earnings. The cushion between dividend and earnings helps companies avoid capital destroying dividend cuts even when earnings are disappointing. That said, um, those flaws could be amplified in 2020 and beyond as companies struggle to deal with the pandemic. Consistently paying or growing a company's dividend is a result of past financial performance, not a sign of future dividend success. Focusing on dividend results ignores the current environment, changes the consumer taste or global demand, and how well positioned a company is today. And this is really important too. Extra caution is required in today's market. While the above warning signs offer great guidance more than normal times, 2020 is without a doubt a historical outlier. Some stocks that wouldn't normally look like risky picks will end up cutting dividends, and as evidenced by the earlier examples, even blue chip dividend stocks may suspend or cut their dividend. Make sure that the stock of companies you're looking to buy for dividend income are producing goods and services that will still be in demand during the pandemic, or the demand for those goods and services will see a quick rebound. So this is exactly what I said. You should invest in what you already buy. And the thing is, there are certain things, like I said earlier, that you have to buy. Hopefully, as a human being, you buy toothpaste, right? Deodorant and soap and toilet paper, right? And electricity and water. Look at the things that you don't have a choice in buying, that you have to anyway, and then look at the brands that you buy and then figure out the companies that own those brands, because if you're buying them, odds are a lot of other people are as well. So anyways, guys, those were 5 companies and a little bit of a dive on how to avoid it, because that's really what this is about. Is during times like this, it shows you what companies thrive in a bad environment. And if those companies thrive in a bad environment, that means they'll do even better in a healthy environment, right? So, sorry, I didn't mean for the video to be that long, but I think it's really important to really deep dive into that kind of thing, because a lot of people want to know, oh, where should I be putting my money? What should I be doing? I'm not a financial advisor. I can't tell you how to invest in your portfolio. But what I can tell you is this is the type of economic and this is the type of economic shakeup that really shows you where money should be during a bad time, where you should put your money to keep it safe and kind of get in kind of a safety box and be less exposed to something like this, right? Because certain companies, of course, everything's kind of slowed right now, but there are certain companies that are still making money regardless. And so that's kind of the whole point of the last couple videos of talking about cutting dividends is it's up to you to determine what's a healthy investment and where to put your money. But if you're new or if you're learning, this type of correction is very helpful, because it shows you where your future money should be in order to be well protected against something like this. So anyways, guys, those are 5 blue chip stocks that have cut their dividends. My heart does go out to anybody who had to deal with the dividend cut. I did myself. I bought Wells Fargo about a month before they cut their dividend. I did get paid and reinvested in an AT&T, so it wasn't a terrible loss. I got out quick, but it affects even. I'm not super seasoned as an investor. I've only been doing it for 2 years, but even Warren Buffett got slammed by this economic slowdown. So even the greatest investors of all time and the people that we look up to in this financial space make mistakes as well. So don't get too down if you did get a dividend cut. Just try to use it as a reminder to research further and maybe not make the same type of mistakes, or maybe stay away from an industry that really did get affected in this time. So anyways, guys, I'll see you guys in the next dividend investing video. Remember to subscribe to my YouTube channel, That Dividend Guy. I have portfolio updates coming out every day. I have stock market news, and I do also try to cover stuff like this just to try to help newer investors, because I hate when newer investors chase yield. I hate when people get overexposed to stuff gets that makes them lose money. I really want everybody to be successful. I want everybody to be smart, seasoned investors, and I want people to learn a lesson, but I don't want them to have to lose money in order to learn that lesson. So thank you guys so much for watching. Remember to hit the subscribe button, and I'll see you guys in the next dividend investing video. Take care, guys.